Banks have taken a huge €489 billion in the ECB's first ever offering of 3-year funding. A total of 523 banks took money at the tender, with demand way ahead of the €310 billion expected in a Reuters poll. The offering raises hopes a credit crunch can be avoided and that the money may be used to buy Italian and Spanish bonds. Stocks on the euro have reacted well to the news. Justin Urquhart, steward of Seven Investment Management, says the move should reinforce bank credibility.
It is fascinating to see how this has been offered. It's almost can be seen as being offered cash for trash if banks are going out there to encourage to go and buy up other assets, or even only just to shore themselves up. No. Now is the time for banks to come out with a clear message that they are as strong as possible.
Charles Diebel, Head of Market Strategy at Lloyds Bank Corporate Markets, joins me now. Charles, is this really going to ease the debt crisis?
It's a short-term solution, effectively, a bit like we've seen everywhere else so far. What it does do, it provides banks with liquidity. It allows them to post collateral off their balance sheet to the ECB and get funding as a result. Arguably, it is almost a form of QE. Certainly, QE by stealth, perhaps, is a way to describe it. But it's not. It's not the solution to the problem. What it does is buy some time.
Sure, but if they've got enough liquidity for day-to-day operations, if they've got enough firepower now to buy their own sovereign debt and finance their economies, so to speak, that surely means less of a debt crisis.
At the margin, yeah. I mean, I guess the way I would describe it is it lowers the systemic risk, particularly from the point of view, perhaps, of a bank failure, as in the banks remain funded. You know, you've got to remember we do also have another one of these tenders in February, which I suspect will also be well taken up. So, you know, they are providing a lot of liquidity, but, you know, that doesn't solve the sovereign issue. It doesn't solve the fact that, you know, you have a long-term plan towards fiscal union and all of the haggling and political issues that go with that. And that's the real long-term story.
And how do you play this in the market as head of rate strategy? Do you suddenly think, okay, that we're going to see banks probably piling into some of this debt? It looks more attractive for that reason?
I think, broadly speaking, it means that you have to be less worried about a real risk-off seizure of the markets, but there's no particular reason as a result of this to turn around and go massively long of Spanish or Italian debt. But it does remove one of the major reasons to selling it, and I think over a period of time there will be more support, particularly when we get the next LTRO in February, because I think probably this one was more about banks getting assets and packaging assets up and taking them off their balance sheet and putting them into the ECB.
From the bank's perspective, do you think the ECB has successfully removed the stigma of taking ECB funds?
Well, as you just pointed out, 523 banks is a lot of banks.
Yeah, but it was over 1,000 back in 2009.
Well, absolutely, but I don't think there's really a stigma. You know, this is a game for survival at this point, and you know, I don't think, given 523 banks did take part in it, I don't think you can really say that there's a stigma attached, and banks were trying to avoid it. You know, 489 billion was right at the top end of expectations. So, if there is a stigma, then that's obviously not an obstacle to banks taking this liquidity. And
which banks and which country do you think would have been the heavy takers?
I think all of the Eurozone banks would have been involved across the spectrum. Clearly, those that have a lot of peripheral debt on their books, so, you know, Spanish banks, Italian banks, Portuguese, Irish, Greek, they're going to be very natural players in this, but I think most likely you'll have seen French banks and German banks very heavily involved as well. So I think it's probably across the board.
All right, Charles, thanks a lot for talking with us. Charles Diebel, Lloyds Bank Corporate Markets. I'm Axel Threlfall. This is Reuters.